Under the NCUA code, there's a section of their call report which has been earmarked to allow credit unions to invest in things that they otherwise would not be able to invest in. And the goal of using these alternative investments is to offset the cost of benefit expenses. So benefit expenses are a lot. They're rising fast. They're going to be here for a long time. There's probably no point in time in the future where you're going to get rid of your health insurance program. You probably lose all your employees. So the NCUA realizes that the way most credit unions invest with the bulk of their assets is very conservative, it's very safe, and therefore has a historically lower rate of return. So for many credit unions, they invest most of their assets in, call it 10-year or less debt securities or bonds. And so short-term bonds has a certain yield profile to it. Well, under this, it's section 20 of the call report, at least that's what it was up until last year. They changed their call reports. The NCUA allowed credit unions to invest in what are called otherwise impermissible investments. These are typically securities, so mutual funds, ETFs, things of that nature, life insurance contracts, which is what we are experts in, and annuities. And so these three sort of asset classes, there's this window through section 20 where the NCUA says you can go and invest in these things in order to offset benefit expenses if you want. Okay? And the idea is to earn more than the other things that you are typically investing in as a credit union. And so from an asset perspective, life insurance affords a couple of advantages. Historically, you earn more than you will with short-term debt securities or bonds. There's a death benefit, which is very meaningful and will increase the total rate of return of the investment class. It's very, very safe. These are issued by A+ S&P life insurance carriers, most of which have been around 120 to 150 years. So safety, liquidity, a higher rate of return, that's the profile of the asset classes that are available within the life insurance space. So it's as if you had 95% of your investments in one type of vehicle. All we're saying is take 5%, a very small piece of your total assets, and invest in things that are different, that have a different profile, a different expected rate of return, because you do need to earn more, because the cost of benefit expenses is rising at a very fast pace, and you can't keep up. So you need to keep up as best you possibly can. And we believe firmly that life insurance is that tool to do the very best job, all the while maintaining a very high level of safety and a very high level of liquidity. So you can get out and do something else if you deem it to be worthy of those dollars down the road.